Most traders enter the market believing that success comes from finding the perfect setup, the perfect indicator, or the perfect entry model. But what they don't realize is that timing is more important than almost anything else in trading. The market does not behave the same way at all hours of the day, and ignoring this fact puts you at a massive disadvantage before you even place a trade. ICT Killzones exist because institutional money does not operate randomly. Large banks, hedge funds, and financial institutions execute the majority of their positions during very specific windows of time, when liquidity, volume, and participation are at their highest. If you are trading outside of these windows, you are often trading against randomness, low volume, and inefficient price action, which is why many traders feel like the market makes no sense. Kill zones are not a strategy on their own. They're a framework that tells you when the market is most likely to deliver meaningful, tradable moves. Once you understand this, you stop trying to trade all day and start focusing only on the moments that actually matter. The London kill zone and the New York kill zone are the most important because they represent the overlap of global liquidity and institutional intent. During these periods, price is not just moving, it is seeking liquidity, filling large orders, and establishing direction. Outside of these times, price often ranges, drifts, or creates misleading moves designed to trap impatient traders. One of the biggest mistakes retail traders make is believing that if they miss a move, they have missed the opportunity of the day. In reality, most strong daily moves are built around liquidity events that happen during kill zones, and if you are patient, the market will often give you a second chance through retracements and structure shifts. The Asian session usually sets the stage by creating a range, and that range becomes a target later in the day. During the London kill zone, price frequently attacks the highs or lows of the Asian range, triggering stops and breakout traders before revealing the real direction. This behavior confuses traders who do not understand liquidity, but once you expect it, it becomes one of the most reliable patterns in the market. The purpose of these false moves is not to manipulate you personally, but to generate the liquidity institutions need to enter large positions without excessive slippage. When you understand this, you stop reacting emotionally to stop hunts and start anticipating them. The New York kill zone often completes the story of the day. By the time New York opens, liquidity has already been built, structure has been formed, and bias is clearer. This is why many of the cleanest moves happen during this session. However, chasing price during New York is one of the fastest ways to lose money. Professional traders wait for price to retrace into areas of interest after liquidity has been taken. Kill zones teach you that patience is not optional, it is a requirement. Another critical aspect of kill zones is preparation. Trading does not begin when the session opens, it begins hours before. You must know where liquidity is resting, what the higher time frame bias is, and which levels matter. Without this context, kill zones become meaningless. Many traders fail not because they don't know what to look for, but because they look for it at the wrong time. When you combine kill zones with structure, liquidity, and higher time frame bias, you dramatically increase your probability. Not every kill zone will offer a trade, and this is something most traders struggle to accept. Some days, the best trade is no trade. This mindset shift alone eliminates overtrading, which is one of the biggest reasons traders blow accounts. Kill zones force you to respect time, and respecting time forces you to respect discipline. Over time, this changes the way you experience trading. Instead of feeling pressure to constantly act, you become comfortable waiting. Instead of reacting to every candle, you observe price behavior with intention. This reduces emotional fatigue and improves decision-making. Risk management also improves naturally when trading kill zones because entries are more precise and stops can be placed logically beyond liquidity. This leads to better risk-to-reward ratios without forcing trades. The psychological benefit of kill zones cannot be overstated. Most traders lose confidence because they trade too often and experience constant emotional swings. By limiting trading to specific windows, you reduce exposure to noise and increase exposure to clarity.
Confidence then comes from executing a plan, not from winning a single trade. Kill zones are not about predicting the market, they are about aligning yourself with when the market is most honest. When volume is high and participation is real, price reveals its true intentions. When volume is low, price lies. Traders who understand this stop blaming the market and start taking responsibility for timing. Over time, trading becomes calmer, more structured, and more professional. This is why ICT kill zones are so powerful. They do not promise more trades, they promise better trades. They teach you that trading less is often the fastest path to consistency. When you stop trying to be in the market all the time and start trading only when institutions are active, everything changes. You see cleaner setups, you experience less stress, and you begin to understand the rhythm of the market instead of fighting it. This is the real purpose of kill zones, not to give you signals, but to give you structure, discipline, and clarity in an environment where most traders are lost.